Okay, our next presentation is by Mike Cagney, CEO of SoFi. And SoFi just reached $500 million last week in total loans originated. So congratulations to them on that. What Mike is going to talk about is, we've talked a bit, they've heard the word securitization a lot today, and there's certainly, and John just said it as this last panel closed, that it's sort of, this industry was built on simplicity and transparency, and the fact that it's really a simple flow of money from one entity to another entity. And what happens when we start securitizing? What happens to the peer-to-peer piece when we start securitizing? I think I'm really excited to hear this presentation. So please put your hands together for Mike Cagney.
Thanks. I'm going to caveat that I put this presentation together, not my marketing department, so you can see why I don't run marketing in a few minutes, but hopefully it'll be effective in communicating what I want to get across. I put together a pie chart that shows the composition of the current consumer lending market in the U.S. So you've got $14.5 trillion or $11.5 trillion in consumer credit that's outstanding, and this is the breakout. You've got effectively mortgages at about $8 trillion of that, student loans a little over $1 trillion, cards at almost $700 billion, auto at $800 billion, home equity at $576 billion. And I think that the key on this is the average rate for each of these categories. So mortgages at 4.4, home equity 4.9, auto at 4.5. Cards are the anomaly at 15.6 in terms of a higher yielding consumer credit. And so the question becomes, if we're all thinking about how we're building transformative, disruptive models in financial services, we're going to have to figure out how do we go after these lower yielding asset bases, because we can't go to the traditional hedge fund source of capital where we can get them a double-digit return, or at least not on a nominal unlevered basis. So what is the approach that we need to take? And the reason this is notably relevant right now is some changes in the banking system and the banking environment. In particular, banks traditionally have had the advantage of a deposit base, a zero marginal cost of funds for that deposit base. And that's allowed them to be aggressive and to go into these low yielding asset classes very effectively. They're also the incumbents in the sense that they're in the market today. But there's some dynamics that have balanced out the bank advantages, and notably perception, regulation, and focus. And perception is one of the structure that there's a lot of people that don't like their banks. They want a different kind of financial services solution. I think that, the notion this morning about people prefer to pay money into an individual than they prefer to pay into that monolithic, faceless organization is true. Further, the banks are under intense regulation in terms of their consumer lending businesses, their mortgage businesses. It's extremely hard for them to be active and aggressive in consumer finance. And third is focus, that it's traditionally been hard for banks as depository institutions to be very laser beam focused in the kind of credit they originate. And so this construct has given us an opportunity for the first time to think about how do we go after some of that market that's traditionally been dominated by banks, and how do we bring an alternative approach to lending in this space. Securitization is one way to do this, and the advantage of securitization is, at the end of the day, it's the cheapest form of capital that an institution can source. Securitization is a very basic premise that you take a pool of loans and you split it into two buckets, a bucket of senior financing and a bucket of equity. You can be much more complicated and involved in this. You can have 13 or 14 buckets there, but in its most basic form, you're just taking a pool of loans and you're financing it with two different levels of risk: a senior, relatively low coupon, and an equity, relatively high yield component. I went last night, I looked at Bloomberg at some recent securitization markets in terms of all-in cost of capital. So this is both the debt and the equity that underlies it. And there's been a $1 billion card deal that priced in at an all-in cost of capital at 3.9%. $749 million is subprime auto that priced in at an all-in cost of capital at 2.1. 186 million of non-conforming resi mortgages at 2.72. So you can start to see that there's an incredible funding advantage that comes from securitization and allows you to be very aggressive and go after these historically lower yielding asset classes and a structure that levels the playing field. We did a securitization last December. It was the first rated transaction in the peer-to-peer space. It was a DBRS single A rating. We issued close to 152 million of single A rated senior notes, subordinated by 16.4 million of equity. That ended up being a 3.75% fixed rate against a portfolio with a weighted average coupon close to 5 3/4. Net of all fees, the underlying equity yields out 10 to 12%. And the reason we were able to do this transaction is we had a very special book. So it was 90% current pay. It was a relatively super prime borrower set, so 750 FICO, $4,300 of free cash flow, 130,000 in average income. And consequently, the equity that we sold was significantly oversubscribed on the institutional side. So we were able to create a structure that was very desirable to two different kinds of investors. To the asset manager on the top end who needs a rated transaction, a rated security, is looking for security and modest yield, and the equity investor on the bottom end is looking for a low double-digit return with a very attractive risk profile. Now, what was unique about this securitization and specific to what we did was we kept the equity primarily for retail investors. And I'm going to go into that in some more detail in a minute, but actually let me hop into it right now and show you what it looked like, and I'll come back. So effectively what we did was we had retail investors provide warehouse financing to the business on day one. So they would invest in an unlevered fund, they'd earn a nominal coupon of 5%, and they'd effectively have exposure to the assets in those funds. And they were delineated by school. So if you were a Harvard alum, you could invest in the Harvard pool. If you're a Stanford alum, you invest in a Stanford pool, and so forth. And when it came time to securitize, these individuals had the option to elect to swap their underlying fund interest into the equity interest on the securitization transactions. So they effectively went from an unlevered mid-single digit yield into a levered low double-digit yield. And what we did in this transaction is we were the primary issuer, and we sold the equity through our broker dealers, so we were able to actually get accredited investors into the underlying equity. Normally that's limited to a QIB, a qualified institutional buyer. But the way that we structured it, we were able to get accredited retail into there. And that was the predominance of the transaction. It was also oversubscribed. We weren't able to get all the retail money that we had into the transaction, but we got a lion's share of it. So if you think about the market and you think about what you need to pull this off, the biggest thing that the rating agencies look for is operating history. And you need a rating agency to make a securitization happen. You can securitize without one, but you're defeating some of the purpose, which is you're really looking for that institutional high quality asset manager to buy your senior note and give you relatively low cost of financing. You need performance history, and that's notable because you want to make sure, especially as a new issuer, loans are performing the way that you anticipated them to. At SoFi, we always had a theory that the loans would be incredible from a credit performance standpoint, but people needed to see it before they believed it. It wasn't something they'd take at face. You need servicing in place, and for some markets, servicing is more important than others. In student loan refinancing, it's incredibly important. So the rating agencies want you to have a rated servicer and want to ensure that, that they're going to be very diligent in terms of surveillance. Surprisingly, to me at least, in mortgage, it's a lot less relevant who the servicing is because it's a secured credit. You want to have a team that's got experience in doing securitizations. We were fortunate that between a couple of us, we've done multiple billions of dollars of these transactions, and so consequently, we knew a lot of the players in the space. You need interim financing because to do a securitization, you need to hold the loans on balance sheet for some period of time until you execute the transaction. That interim financing is usually in the form of a warehouse, and the warehouse is going to require the same level of diligence. And most notably, you need loans. And when we first started with SoFi, and a lot of you have heard this story before, but we went out to the street and we said, we have this phenomenal asset class. We think it's a great credit. It's going to perform really well. we need a warehouse. And this was back in the summer of 2012. And we went through a very humbling process of talking to every major bank. And every bank said, you know, we love your idea, this is great, awesome, let's keep in touch, which means we're not giving you a warehouse. And it was an interesting process for us. And we had to do something pretty heterodox, which is we went out and raised $77 million of equity that summer to basically put on our balance sheet, fund loans, and build a history such that in the spring of the following year, we were able to go back out to the street and get the warehouse financing, and then 6 months thereafter, get the securitization done. So there's a little bit of a challenge in the chicken and egg phenomena here that you need critical mass to get a securitization in place, but you're not going to get that interim warehouse financing unless there's a perceived takeout that there is a securitization that's going to come. And so we had to go a route of self-financing, which wasn't necessarily the most painless, but it was effective. In terms of the market, I put this up here just to delineate out who's in the securitization space. So 56% of the folks who buy senior asset-backed securities are asset managers. They're mutual funds. To a lesser extent, you've got some pensions and lifers in there as well. You've got some banks. And then on the equity side, you've got retail and you've got hedge funds. And effectively, by breaking these two out, you can go into a category of a nominal yielding asset. So say a 4.5% auto loan, and you can break out a low coupon, super high grade piece of debt for a mutual fund or an asset manager, and a higher coupon, higher levered piece of equity for your traditional hedge fund or retail investors. And so that's effectively the process. So I said I would do this presentation in 5 slides in 10 minutes so I could open it up to questions. I only have 15, and I'm half a minute over. So with that, I'll open it up to any questions folks have. All right, I'm going to take that I nailed the securitization concept. Okay, thank you very much.